Both crypto and equities finally cracked today, with the crypto market shedding around $100 billion in market cap, along with US stocks giving back recent gains. The pullback was not random. It was driven by a confluence of macro policy and sentiment shocks that we've constantly highlighted in previous reports as key downside risks. Surpass current market sentiment and flip back bullish. The highest that I think XRP is going to go under those conditions before more aggressive profit taking is 444 and 517, where we have two resting sell deltas. All right, sweet. So picking up where we left off from yesterday, as a community, we sat through the painful fundamental analysis. Is always just the boring stuff that nobody wants to pay attention to. But in moments like this, where the market sheds $100 billion, you don't want to be one of those misinformed, uninformed retail investors that thinks that everything's going to fall apart, that crypto isn't underlyingly bullish. And it would behoove everybody to just pay attention to these things. If you're not doing it actively on your own time, then definitely make sure that you guys are reading my reports, you guys are watching these Zoom calls, and you're staying in the loop with what's happening, because we discussed this as a community yesterday. So roughly at about 24 minutes and 8 seconds into our Zoom call yesterday, we had typed out the key drivers that would weigh on market sentiment today, leading to a failure to break into new high territory above $4.25 trillion and lead to a slight market retracement. Nothing extensive. That was our first bearish analysis that we delivered yesterday. If we go and we take a look at the total cryptocurrency market cap today, nothing outrageous, nothing overly extensive or unrealistic. I had said that most likely we would see a slight retracement down into at least $4 trillion as our first target. At the deltas and the total market cap right now, we can see buyers making an attempt to poke higher. And so if we see buyers lose stamina, right? Sellers trap buyers at highs and start to become aggressive, pushing price back below the delta, while at the same time, we start to see a shift in fundamental headlines. So we see a hawkish tone from Fed speakers, or any shift away from rate cut expectations in the FOMC minutes and meetings or Powell's speech this week. If we see any stronger than expected economic or inflation data that reduces the likelihood of near-term rate cuts. If we see any Bank of Japan policy surprise, meaning the market starts to pace in or price in a faster or larger than expected rate hike. If we see any breakdown in the Gaza ceasefire talks, so any renewed escalation that brings back the geopolitical risk. And if we see any prolonged US government shutdown or any type of data releases that create any type of uncertainty or spark investor, or dampen investor confidence that push back on this rate cut narrative, while at the same time we see buyers trapping or sellers trapping buyers and becoming aggressive, pushing price back below the delta, then we know the likelihood is not that we're going to break higher into new territory to respect a sell delta, but instead we're likely to start making our way back down in the form of a pullback to see if buyers can then come and defend at the buy delta. You can see that we failed to break above that $4.25 trillion delta zone with bullish momentum, and we have made that slight retracement. Market shed about $100 billion over the last 24 hours. Let's go over in today's video breakdown why that was. So just looking at yesterday, remember we had talked about some key drivers that would weigh on market sentiment. You guys said hawkish Fed speakers, stronger than expected economic or inflation data that reduces the odds of near-term interest rates, Bank of Japan policy surprise, any faster or larger than expected rate hikes from the Bank of Japan, any breakdowns in the Gaza ceasefire talks or rhetoric between the United States and the Middle East souring or coming out more uncertain, driving more demand for safe haven assets, prolonged US government shutdown. That was one of the key attributes yesterday and the drivers that we typed out as a community. And then we mentioned equity market exhaustion. All right. After strong rallies, any profit taking or weak breaths could lead to pullbacks in other risk asset classes. So that was the list that we had drawn out today, and we can see that list reflected in today's fundamentals. So going over this report that I wrote for you guys this rising. After weeks of relentless risk-on momentum, both crypto and equities finally cracked today, with the crypto market shedding around $100 billion in market cap, along with US stocks giving back recent gains. The pullback was not random, it was driven by a confluence of macro policy and sentiment shocks that we've constantly highlighted in previous reports as key downside risks. Here's just a screenshot of our XRP analysis yesterday. I mentioned that if we saw a risk off market mood driven by some of these factors, we would likely fail to break above $3.11, and we would likely start to make our way back down towards $2.76. And again, same thing, no unrealistic price predictions here in this community. We just use institutional insights. You can see we failed to break on XRP above $3.11. Buyers got trapped at these highs. Sellers slightly have showed their hand, and we start to make our way back down towards that demand region at about 275. Right? So nothing unrealistic, nothing out of the norm. If you've been paying attention, you've been locked in with us, this is all stuff that we've prepared you guys for. All right. So let's go over this in detail. Let's finish reading this. So, what are some of the key factors weighing on prices today? Number one was the Fed officials signaling stagflation risks and policy uncertainty. Remember that terminology right there, stagflation? That is a risk-off terminology, just like the word uncertainty. When central bank speakers say the word uncertain, they say inflationary risks remain skewed to the upside, so on and so forth. That paints a very bleak and uncertain picture of the future trajectory of the economic backdrop, which then leads into uncertainty around the future path of monetary policy easing. We know that one of the key drivers of risk assets, particularly equities and crypto, has been the market pricing in a high probability of easing from the Federal Reserve. Well, if that landscape becomes uncertain due to higher inflationary metrics, then we know inherently what does that do? It usually tends to lead to a supportive dollar environment and weaker risk assets, including crypto and stocks. We saw that reflected today. So, Minneapolis Fed Neil Kashkari made headlines by stating that the recent data is sending some stagflation signals, raising concerns about a combination of slowing growth and sticky inflation. He also noted that it's too early to assess whether tariff-induced price pressures will persist, which is a clear acknowledgement of upside inflation risks. All these things that I highlight in bold for you guys are just key vocabulary that you all should pay attention to. Upside inflationary risks ahead of critical Fed meetings, which is we get the release of the meeting in minutes tomorrow. Meanwhile, San Francisco Fed's Mary Daly warned that a potential AI bubble in equities could threaten broader financial stability. When he said that, the market freaking sold off. I don't know if you guys trade futures today, but futures markets took a freaking piss today when he said that. And this adds new cautionary notes for risk assets that have leaned heavily on the AI trade to sustain momentum. So if you guys remember I think it was like last week's report or maybe even weeks before that, let me scroll down here. I found an article that even supports this. Remember, one of the primary reasons as to why stock markets and crypto were rallying is not only because the market is pricing in aggressive easing from the Fed, but we had upbeat earnings reports from multiple AI companies. So you can see here, this is from 4 weeks ago and 5 days ago. AI stocks that fueled the bull market, earnings reports from different stock companies fueled the third quarter rallies, right? So when one of the Fed speakers today dialed back the sentiment by saying here, it says, San Francisco Fed Mary Daly said that a potential AI bubble in the stock market could threaten broader financial stability. The markets took an absolute piss and saw that as an uncertain headline. And they were like, oh, nah, we're going to scale back that uncertainty. And they sold the positions, right? So again, just another factor weighing on market pressures this rising. These comments arrive at a time when markets are priced for aggressive rate cuts, so any hint of stagflation or policy hesitation carries outsized impacts. The second thing weighing on market sentiment today was we had inflation expectations tick higher and labor market weaken. Fresh data from the New York Fed Consumer Expectations Survey, which you guys can track and read yourself on either Forex Factory or Trading Economics when it dropped this morning. Fresh data from the New York Fed Consumer Expectation Survey showed a jump or a rise in short-term and long-term inflation expectations. 1-year expectations rose to 3.4%, which is the highest reading that we've gotten in 5 months. The 5-year expectation ticked up to 3.0%. At the same time, labor market expectations continued to deteriorate because of the lack of data that we're getting because of the government shutdown. Consumers right now see higher unemployment over the next year, lower earnings growth, and more job loss risk, which obviously, of course, tends to spark fears of a recession. This combination of rising inflation expectations plus continued cooling in the labor market outlook fits exactly into the stagflationary light scenario. We have discussed this in previous calls. We know that a stagflationary environment complicates the Fed's ability to cut rates and forces the market to reprice in that risk premium. So if we know what was driving the rally before was the market pricing in aggressive cuts, but then today we had higher inflation expectations, and we know that that clouds the future trajectory of the Fed's ability to cut rates. What does the market usually do when it gets that data? It takes a breather, it reprices that in, and again, it dials back some of that recent optimism that we've seen driving prices higher. Okay. You can see that in the report headlines here, October 7th. Short-term inflation expectations continue to tick up. Now, moving forward, just so that way you guys learn, what would have been net positive today or should have been net positive today if we were to see these headlines? Look at this vocabulary headline right here. Short-term inflation expectations continue to ... What would have been more favorable for risk assets? Instead of it saying tick up, it would have said something else. What would have been more favorable for a risk on environment today?
Maybe soften or tick
Yeah.
down.
Right. Yeah. Like cooling inflation data or the inflationary metrics show that inflation is continuing to come down or lower or cool, right? Those types of vocabulary words. Obviously, of course, inversely to that, it showed the opposite, right? Higher inflationary metrics tend to weigh on future trajectory of the Fed's ability to ease, which we know leads into a trickle effect and sell pressure on risk assets in a more favorable dollar environment. Very simplistic, right? Moving on. Number three, we had the government shutdown adding to the market uncertainty. So in yesterday's call and in last week's call, we had mentioned that if the government shutdown continues to prolong, it actually might feed an uncertain environment. We know the market does not like that word. When that word uncertainty is in the headlines, we know that it usually tends to reflect itself in sell pressure and risk assets, or at least larger investors than you and I taking less aggressive risk on bets. And so we're starting to see that unfold as the market was previously pricing in that the government was going to be able to come to some type of conclusion and end this shutdown. But now that landscape is not seeming to be so clear. So markets had previously shrugged off the US government shutdown, expecting a quick resolution. That confidence is now fading. As both parties remain deadlocked, the shutdown has extended into its seventh day, raising the risk of delayed economic data precisely when the Fed needs clarity to guide policy into this year's end. This data gap introduces another layer of uncertainty for both policymakers and investors, just as rate cut expectations are finally balanced. So you can see here in the report, it says investors have been brushing off the US federal government shutdown last week, with the markets confident that a quick resolution would be found and an economic fallout would be minimal. That confidence may prove to have been misplaced. And so whenever the market is overly confident about something, remember the markets price it in. When those expectations are dialed back, the market has to recalibrate that, right? And that's exactly what we saw today. Moving on, we also had number four, AI sector and market breadth weakness on the equity front. AI figures faltered, dragging down broader indexes. Oracle stock slips 5% on a report that the company is seeing thin cloud margins from NVIDIA chips. Now, the reason why I highlighted this report right here, you can see the date, October 7th, 2025. Well, if we remember a couple weeks ago, right, it says right here, 5 days ago, 4 weeks ago, what was driving risk on sentiment was upbeat earnings reports from the same company. Oracle stock soar on AI-fueled quarters, upbeat earnings reports. Well, here it says Oracle dropped over 5% on chip supply concerns. So we had some instability in the data that Oracle provided today, which weighed on the recent optimism that was priced into the market around AI stocks. Tesla also slid, and Ford also tumbled nearly 7% after supply disruptions were reported. Fed warnings about AI froth added fuel to the sell-off. So remember, we had one of the Fed speakers say that there's a bubble in AI, while at the same time, we're getting bad reports from industry-leading experts in the AI field. So with AI being a core pillar of the recent equity rally, weakness here quickly spills into other risk sentiment as well, like cryptocurrency. So when we saw the equity sell off, that obviously, of course, trickled into a whole entire broad risk off sentiment today and has led to the $100 billion pullback in crypto, which could or could not be over depending on how the data tomorrow that we get in the FOMC meeting in minutes unfolds. So, why this fits the risk backdrop? Remember, we touched on this in yesterday's report. We painted this together as a community. You guys nailed it on its head. So, hopefully, today, nobody is unclear or uncertain about the current landscape, as we already predicted that this would likely happen yesterday if this type of environment was painted today. So, in previous reports, we outlined three main risk off triggers: a hawkish or uncertain Fed tone, especially if stagflation risks rise, a geopolitical or macro shock that undermines risk appetite, or market expectations misaligned with the Fed's reality. Today, all three of those signals flashed red. We had Fed officials raise stagflationary concerns and question financial stability. We had inflation expectations rise while labor market expectations continued to deteriorate. We also had the shutdown drag on, raising data uncertainty. And then last but not least, we had market leaders falter, triggering technical and sentiment selling. So looking ahead, this type of reaction was not unexpected. It's exactly what happens when markets rally ahead of fundamentals and the narrative suddenly shifts. If Fed officials continue to push back against aggressive cut expectations, or if inflation expectations continue to keep climbing, risk sentiment is likely to continue to deteriorate further. Our focus tomorrow is going to be on the FOMC meeting in minutes and the tone that the market gathers from the Fed's comments. So we'll likely read that together as a community. I'll get my highlighter tool out, yellow, red, and green, and we will go in and we will determine whether the Fed meeting in minutes leans more hawkish, neutral, or dovish. Coupled with any ongoing uncertainty around the government shutdown and scheduled data releases, that is going to be our key focus. Conversely, if geopolitical developments remain calm, upcoming Fed speakers lean more dovish, supporting the monetary policy easing narrative, then we could see temporary stabilization. We could see a rebound in today's risk off sentiment. But today was a reminder that when markets are priced for perfection, which they have recently been, remember we talked about how the rally led to a rainbow scenario. The market was pricing in a rainbow scenario. Continued monetary policy easing, deterioration in the labor market without sparking fears of a recession, lower inflation, right? We had Hamas and the United States signaling a possible ceasefire. All these things were like screaming risk on, risk on. But as soon as something shifts that sentiment that the market was previously pricing in, we have to be prepared and mentally ready to react, as we can clearly see that the markets are still heavily tied to these fundamental backdrops. All right. We're not out of a trading environment yet. And so that means if this sentiment continues to deteriorate, we're likely to see a further decline in prices. Inversely, the upside is obviously, of course, not weighted. If the sentiment flips back risk on, then we could clearly see a continued rally in risk assets. So let's briefly talk about that real fast and go over this. Now that you guys understand the current backdrop, let's talk about, again, what could bring back market sentiment as a community. So tomorrow we have the FOMC meeting in minutes. It doesn't really look like there's any other data outside of just, let me just go to forex factor real fast. Tomorrow, outside of the FOMC meeting in minutes, we have crude oil inventories. We do have some scattered Fed speakers before we get the FOMC meeting in minutes, so that's going to be important. Mausoleum, Barr, and Goolsbee are all going to speak tomorrow. So if they do deliver some rhetoric on monetary policy or the economic backdrop, it will be important to pay attention to. You have to understand that not all these speakers deliver sentiment on monetary policy. So, for example, like today, Fed Bowman, when she spoke, she didn't say anything about monetary policy. See, it says right here, Vice Fed Chair Bowman did not talk about monetary policy or the economy during her community banking event. So it's not every single time that we get insights into the economic outlook or monetary policy from these Fed speakers. But when they do say things, it's important and imperative for us to pay attention, as it does sometimes direct the momentum in the market. All right. So that's really all our focus is going to be on tomorrow. So tomorrow might be one of those days where we don't see any excessive volume and volatility, especially if the Fed meeting in minutes comes out at what the market is currently expecting, which is a split between hawks and doves. We would ideally like to see the Fed rhetoric leaning more dovish, meaning dovish Fed speakers outweighing the hawkish Fed speakers. And that would likely lead to stability in risk assets, or at least a slight recovery, or at least no further deterioration in the current sentiment. Inversely to that, if the sentiment tomorrow from the FOMC meeting in minutes is more favorable to the hawkish side, pushing back on the future trajectory of interest rate cuts and lowers the probability of October or December cuts, then we're likely to see the selling pressure persist and the dollar gain more stability against major trading pairs, right? Heading into Thursday, we have Fed Chair Jerome Powell speaking. That's going to be important. Again, if he delivers any commentary on the economic backdrop or monetary policy outlook, hopefully the government can resolve its issues and we can get insights into the employment data. Remember that they pushed back the unemployment rates and the non-farm payroll report. The last government shutdown that we had to live through like this was that in 2018 and 19. I wasn't paying attention to fundamentals like I am today. So I will just continue to deliver it for you guys in real time as the market reacts to upcoming events. All right. But hopefully we can get that labor market data this week and it can show signs of cooling without sparking fears of a recession, and it can favor continued rate cut policy easing from the Fed, right? If that is to be the case, we get dovish leaning comments from the FOMC meeting in minutes and we get data that supports rate cuts, then we're likely to see the bullish continuation in crypto persist. Inversely to that, if we get higher inflation expectations, upbeat labor market data, we get hawkish Fed rhetoric, any of those things push back on the rate cut narrative that's currently priced into the market, we're likely to see a deeper retracement in crypto. So just taking a look first at the total cryptocurrency market cap, we're still in that window. If we continue to see lingering deterioration in risk sentiment, we're likely to pull back down into that $3.67 trillion threshold, or the first bullish delta. That'll be our first area of interest, and for me to look into aggressive buying opportunities. If sentiment deteriorates further than that, then that does open the door for my overall thesis that we are likely to see a pullback and a correction of the previous July and June move, which puts us down into $3.2 to $3 trillion, where we do have some buy deltas lingering. So don't be surprised if that happens in the future. Again, if we zoom out higher time frame, we know in previous market cycles, there have been aggressive pullbacks due to the market scaling back expectations that were future priced in of rate cuts. Remember, we've gone over that in previous video breakdowns in detail. Okay. So if that happens, I would not be surprised if we did see deterioration in the sentiment and a pullback down into these lower buy levels. Inversely, if we don't get that scenario and we don't see the market fade out the current risk premium and we see a market favor pricing in future rate cuts and we see data that supports that narrative along with Fed speakers this week, then we're likely to find support at the current levels that we're trading at, either at $4 trillion, finding a floor and making another attempt to push higher, or again, coming down into that $3.67 trillion, holding that as support and making another attempt higher. But don't be surprised if from here, market sentiment deteriorates further and we did see a deeper retracement. XRP, the reason why I cover XRP is because it's one of the predominant assets that I personally day trade in crypto. So same thing, I'm looking at possible buying opportunities at $2.75 if the market settles and the sentiment turns back risk on for some possible scalps to take from delta to delta. If at any point in time we break 275 and the sentiment deteriorates further, that still opens the door for us to head down into 256 to 242 before possibly considering buying opportunities. Same thing via our upside targets that we previously discussed. They have not changed. Anything above 328 opens the door for a new all-time high at 382. And if sentiment were to surpass current market sentiment and flip back bullish, the highest that I think XRP is going to go under those conditions before more aggressive profit taking is 444 and 517, where we have two resting sell deltas. So nothing out of the norm. Doing technical analysis on crypto every day is kind of boring, as the market doesn't really move that aggressive unless there's some like super shift in fundamental sentiment. So right now we're really just consolidating in between $3.11 and $2.75 before buyers or sellers can take control and pick a direction of bias, right? Nothing pretty crazy. So we'll continue to monitor these fundamentals. I will continue to accurately update you guys. I'm happy that yesterday we were able to take some time as a community and type out these fundamentals together. Now you can see it reflected in the price, how simple it is for us to do this on a day-to-day basis because you guys gave me this list yesterday. So now you guys can see the level of accuracy that you can deliver in terms of your own fundamental analysis by simply just understanding the factors that drive risk on and risk off sentiment, right? So very simplistic breakdown today. You guys now are aware of what happened in the market today, why we shed $100 billion. We're not in some bear market cycle. We're still in a fundamentally driven environment. That means risk assets are affected by these fundamental factors that weigh on aggressive bet taking and risk assets. That sentiment could deteriorate further. We'll continue to monitor that. All right. As always, when the market's down $50 billion plus, this is the time to try to keep your dollar cost average positions into crypto relatively low. That doesn't mean that the market's not going to drop further, but the goal is to minimize your downside risk and maximize your upside reward. How do you do that? You buy when the market's selling off or when the market's at a discount, not when the market's rallying. So anybody that was buying because they were afraid to miss out just a couple of days ago when the crypto market was trading at new all-time highs is now at a loss. We hopefully are avoiding that in this community because it doesn't meet our parameters to dollar cost average in when the market is up $100 billion plus or at a sell delta. We inversely look in this community to buy when price is at a buy delta, when price is $50 billion less shed from the market, when the crypto fear and greed index is below the 50 grade threshold, or when sentiment has shifted risk off. And we are now seeing that environment painted. So today is one of those days where if you have some extra capital, you want to stick it into the market, it would probably be a good time to do that under the understanding that the market could go lower, but that's not the goal. The goal is just to get a lower dollar cost average entry into crypto under the expectation that right now we are early and that eventually we will see higher prices compared to where we're entering in at. All right. That's all that I have for you guys today. I'll leave the floor open for questions. That's your fundamental update. I'll leave the floor open if you guys have anything.